My name is Gabriel Sachs. I'm one of the co-managers of Aberdeen Asia Focus. The trust has an objective of delivering total return from a concentrated portfolio of high-quality, smaller companies in Asia ex-Japan. The reason we think it's important to allocate to Asian small caps is really to tap into the growth on offer in the region. The IMF predicts that 70% or up to 70% of global GDP growth will be driven by Asian economies this year, and that's despite slowing China. Of the next 1 billion people to enter the middle class by 2030, circa 90% of those are going to be in Asia. So that provides a really strong tailwind for good companies that are well managed and that can tap into that real strong growth opportunity across the region. We are picking about 50 to 60 stocks among thousands in the region, and we are very differentiated from most portfolios in Asia and also mainstream indices. So one of the strengths really of Asia Focus is offering diversification in Asia. One of the interesting things that I think a lot of people don't appreciate is how much small caps has outperformed large caps over the last few years. So if you look at the past 3 years, the MSCI Asia ex-Japan small cap index has risen about 7% per annum, whilst the large cap index or the mainstream index is down 5% per annum. So that's really 12% annual outperformance of smaller companies over large cap. So if you are investing in Asia and you've ignored smaller companies, you've really left a lot of returns on the table. Part of the reason for that outperformance of smaller companies over large cap is really a lower allocation to China and a higher allocation to countries like India, but also South Korea and Taiwan, which have performed stronger. So again, that diversification benefits and superior returns that you can get from small caps is the reason you should really be looking at this asset class. In Q3, we made a few changes or strategic changes to the portfolio. We exited 4 positions and initiated 1 new company. The company we initiated is a company called Sinbon in Taiwan. It does cabling and operates across 5 different industries, namely medical, autos, green energy, and industrial and communications. The company has a very diversified client base. It has about 2/3 of their revenue coming from Asia, but they also serve really large multinational clients like Philips, Toshiba, Siemens, and Schneider. So they've got a very strong marquee client base. We're very excited about their exposure to green energy, which is about 1/4 of their revenues. And there they produce cables, connectors, and sensors for power generation for both wind and solar energy. The company has delivered very consistent growth over the years. They have been seeing a shift to higher margin products as well, which has been a supportive change angle towards their profitability. They have no debt on their balance sheet, very high levels of returns, and actually generate good cash flow, so a yield approaching 3%. So we're quite excited about that company. We introduced it at about 1% and expect to build that over time. On the flip side, we did exit 4 names, as I mentioned, one of which was on valuation grounds, also a company in Taiwan called ASpeed. This is a really fantastic business. It's got great returns, asset light. They're a virtual monopoly in the space where they design chips for remote control of servers. So they're very plugged into server growth in the US and from the hyperscalers such as Microsoft, Google, Amazon, etc. But that business did do quite well for us. It has been caught into some of the AI hype that you've seen this year. So it was trading sort of 2 standard deviations above its historical mean, which just means it's trading quite a lot higher than it's traded in the past, on around 60 times forward earnings. And therefore we felt that it was probably time to exit that company, and hopefully we can come back to it if valuations allow. We also exited a company called Pacific Basin, which we've held for a long time in the trust. It's more of a cyclical business that does dry bulk shipping. And that company did very well for us during COVID, given freight rates went off the roof and they basically delivered excess profits and returned those profits through special dividends to shareholders. So we benefited a lot from that during the COVID years. But we felt coming into this year that maybe those excess profits or that period of super normal profitability was coming to an end, and also management was embarking on a bit of an increased investment phase where they'd be adding new vessels against an environment of slowing demand, and therefore we decided it was time to let go of Pacific Basin and focus elsewhere. We also exited a couple of smaller positions. One, a company in Singapore called Nanofilm, which is in advanced tech materials, and the company just wasn't really performing to our standards. Their communication with the market wasn't great, and they missed guidance a couple of times, so we decided to exit that business. And we also exited a holding in the New Zealand Stock Exchange, which is a company that was delivering very good dividend yield, but New Zealand no longer a core part of our investment universe following changes to our mandate in January 2022. So we decided again to focus our energy elsewhere and recycle that capital. The outlook for the rest of the region in Asia outside of China is actually really good. So outside of Thailand perhaps, which has been an economy that has struggled a bit more post-COVID given the hit to tourism there and the slow recovery in tourist arrivals, broadly the region is in a pretty good place. As mentioned earlier, we only have about 10-15% in China, so 80 to 90% of our portfolio actually sits elsewhere in the region, and we're really excited about that 90% really. If you look at the macro environment, Asia has performed pretty well despite really sharp interest rate increases in the US and Europe, which typically, eats into liquidity in markets and leads to sort of currency weakness in emerging markets in Asia. But you haven't really seen that. You've seen a pretty stable macro picture. Currencies perform quite well. And the reason is because these economies have actually managed their economies in quite an orthodox fashion. Inflation has been very benign. So actually you didn't see a big spike in inflation post the Russia-Ukraine conflict like you did in other emerging markets and Europe. And so that macro picture is very healthy, and you're seeing economies recover quite nicely post-COVID. There's also some interesting drivers for some of these economies. There's a lot of chat these days about nearshoring or China plus one, and that's something that we're really seeing happening in certain markets such as Vietnam, Indonesia, and India, where you're seeing duplication or diversification of supply chains and lots of countries trying to tap into that. With regard to our portfolio, we actually have 18%. Our largest market is India. We have also sizable exposure to Indonesia at around 11%, and we have a 6% allocation to Vietnam. So these three countries which benefit from China plus one are a key part of our portfolio. Just to delve a little bit deeper on each, India is now the most populous country in the world. They're seeing very good, strong growth and a domestic capex boom driven by government investment and structural reforms. There's stable politics as well. So again, this provides a very healthy backdrop for corporates in India. We're seeing very good earnings growth come out of our businesses in India. So again, that outlook there is really healthy. Indonesia is also doing very well. It's another populous country, to over 200 million people. Quite a different economy in terms of their reliance on commodities, but you're actually seeing good growth come out of Indonesia. They're trying to move up the value chain to refine nickel, for example, which is a key commodity that goes into electric vehicle batteries. There's also been structural reforms and supportive economic policy from the government. They have elections coming up next year, but actually we expect the policy backdrop to remain pretty stable. We have 4 great businesses in Indonesia which cover a big part of the economy, one of which is a healthcare business, a hospital chain. One is a bank, one is an energy company, primarily in fuel distribution, but also an industrial play in more broader sort of commodities, and also a more straightforward consumer stock. So again, covering the Indonesian economy quite well there in terms of our positions in the portfolio. And finally, Vietnam is a market that probably has one of the strongest macro outlooks, seeing very good foreign direct investment over the years, strong urbanization, very stable currency. It is seeing more volatility lately because of a purge on corruption. And from an equity market perspective, again, given it's a less developed market, it's one that has been more volatile and one that we struggle a bit more bottom up to find companies that meet our quality criteria. But overall, we're very excited about that portion of the portfolio. Historically, throughout the history of the trust, we have been more biased towards Southeast Asia and India, but we also very selective in Taiwan and Korea, where we have decent exposure to really good quality tech companies that are leaders in their field. Thank you very much for listening. I hope you enjoyed the update, and if you'd like any further information, please visit our website or click in the link on the screen.